than your currency. Splurging millions, buying houses like Monopoly. Fucking 9 to 5, man, the money is a joke to me. Buying cryptocurrency, my money in the privacy. I make it rain dollars.
Hey guys and girls, welcome to this week's episode of the No BS with Birchy podcast. I'm your host Nathan Birch, and this is a show unraveling the truth to the facade of the 21st century. We're now exiting the matrix and waking up to motherfucking reality. So thanks a lot for tuning in again this week, guys and girls. This is one of our lockdown lessons. The quality may not be as great as usual because I'm not in my studio. I'm out enjoying nature and beaches and water and, not locked down in the lockdown lifestyle. But I thought I would do a podcast today around something really exciting. I made lots and lots of videos about this over the last sort of 5 years. People didn't believe it to start off with. If I had told you that we would see the banks paying us money to take out a mortgage, you'd be like, Nathan, you're on something. Can I have some? I don't care about interest rates. I want to smoke whatever you're smoking. But people used to not mock the shit out of me, but now they're like, wow, what's going to happen next? Because we're in a world where negative interest rates are a real thing, and they're here to stay, and they're coming in, and there's lots and lots of opportunity with that. Will they always be at negative? Who knows? But I believe there's something that we're going to see in the foreseeable future and within our lifetimes. So, today I want to be, talking about, what indicators signal negative interest rates and it being bound to happen, and talk about my theory behind negative interest rates. So I've got a few articles here, and maybe my editor, if you're watching this on YouTube or that, maybe my editor will slide that into this presentation. But let's go into negative interest rates. So a lot of people don't know what negative interest rates are or how they operate. Basically, interest rates, are defined as like the price that is paid in order to borrow money. So if you were to get a 2% interest rate, you'd be paying 2%. If you had $100,000, you'd be paying $2,000 would be 2% of $100,000. You're paying that as the premium to borrow that money. So if you borrowed $100,000 for a year, you'd be borrowing $100,000 and you're paying back next year $102,000. So $100,000 is the principal, $2,000 is interest. Going back in times gone by, the interest rates were 10%, 20%. If your interest rate was 10%, you'd be borrowing $100,000 and paying back $110,000. If you took out that loan for 30 years, you'd be paying, hundreds of thousands of dollars, way more than the capital back as interest, which, is the interesting conversation because we've got a flawed monetary system. Our monetary system is dying. Our currency that we're using is collapsing. A currency system that we're using is collapsing, and there is no way out of this apart from negative interest rates. If we look at the charts from the RBA, we can see that interest rate policy has gone down basically since the last 30 years. A lot of people have been saying, we've had the greatest property market here in Australia. And it doesn't matter which country you're in around the world. Pull out the charts and have a look at how this happens, right? We've got interest rates which have been falling since, the early 1990s, and they're down now to 0% interest rates. We had a flat interest rate since about 2015 to about 2019. We had 4 years almost of no change on the interest rates. It was flat. It was just, whenever you see, if you're in a hospital and you see someone that's got a flat heartbeat, it means that they're dead. Right, but in our interest rates, it appears that everything's doing great. We've got the amazing economy. The interest rates, in Australia have just gone down and down and down since the 80s, and we're at a point where they can't go back up. We've had, if you were to overlay the cash rate, the Australian cash rate chart with property price growth, it would be like an inverse effect. You'd see the lower the interest rates go, the more that the house prices are going. And, people say, what happens if interest rates go up? I'd love to see interest rates go up because everyone would go bankrupt. Interest rates physically cannot go up anymore because we're stuck at this thing called ZIRP, which is zero interest rate policy. The RBA's charging money, like they lend out $1 billion worth of money, they're charging 0.1%. So 0.1% is 10% of 1%. That's all they charge to the banks and the lenders and whoever's doing the bonds to borrow the money at 0.1%. If they push the interest rate up just to 1%, right, and going back at the start of this the disease that we've got going around the world at the moment, that interest rates were 1% in Australia. If the interest rates just went back to where they were then, that means that the interest rate from today would have to go up 10 times to get to that level, right? Think about who's taking that money. It's not just homeowners. It's not just you. It's just not the person that bought a car or bought something on Afterpay. It's the government. It's the corporations. It's every single, part of the economy has taken out these low interest rates, which are basically zero interest rate policy. So if interest rates went up to where they were beforehand, just even 1% or 2%, we would see so much pain in the economy. Would see everyone go bankrupt. Would see the corporations go bankrupt. Would see our governments go bankrupt. Basically, see everyone go bankrupt. So, can interest rates go up? They could possibly go up, 0.25% or maybe 0.5%, but then they'd have to come smashing back down because the economy is so screwed. And we've already got 0% interest rates. So the only other way out is massive inflation. So we can either have deflation or inflation. Now, if we have deflation in our system, the whole debt bomb blows up. So all the doomsayers would be correct at that point. But the system is so big, the people that are controlling it can't allow that to happen. So we need to keep this system alive as much as we can. So they need to keep printing money. The outcome from printing so much money and making money so cheap to print, or currency as we should call it, means that we will inevitably end with a hyperinflation, meaning that the cost of goods will go up and it'll be the silent tax, and we could have a bit of a reset on that front. So if everything went up in value, then interest rates go up in value. Interest rates could shoot back up to 20%, but it wouldn't be until, a Big Mac meal costs $1 million that sort of situation happens. So go and research past hyperinflation. They're very, very important to understand how they work and how they operate, but also understand what's happening with our currencies now. And I've talked to us today about, what's happening in Australia with our interest rate policy. You just go pull out any of the charts. You can see that the cash rate charts have been in decline for 30 years. And in that same period, we've seen massive growth and massive economic, abundance. But it's only abundance because we've taken out debt in order to fuel our lifestyle. So it either has to come home to roost one day. Someone's got to pay the bill. That bill could be paid in a format of, you having to work hard and take the hard choices, which, our grandparents and great-grandparents, depending who's listening to this, would have gone through the Great Depression, would have been like, we survived on eating dog food and we split a biscuit between 5 of us and whatever. And that was real wholesome, people. But now we're just in some big, giant, debt-based Ponzi fiat monetary system, which we just print more money and we don't have a problem anymore. And we're at a point where we're printing more and more currency into existence, which inevitably is, causing interest rates to be stuck at this low level, which I'm excited by because ultimately as inflation comes through, the cost of everything rises, but my debt becomes cheaper. And I've got a lot of debt. I've structured myself well for this to play out. So it's really, really exciting. But if we go and take a look around every country in the world, we will see that it's not just Australia that's experiencing this. We'll see that, you can find news articles that say Kenya, house prices unaffordable. Philippines, house prices unaffordable. US, house prices unaffordable. UK, house prices unaffordable. New Zealand, house prices unaffordable. And go and look at their interest rates. Go look at the policies. You can see what has happened to their cash rate. You can see what's happened to their national currencies bonds. We can see what's happened to the bond market. And then you overlay the bond market with the cash rate of the country, and you'll see that that's a direct correlation there. And then you start looking at the bond rates of the future, so the future bond rates, and you can start seeing what will start to eventually play out in each and every one of these countries with their currencies. And this is not a country trend. People are saying here in Australia, it's very difficult to buy a property. House prices gone up and they've doubled, or they've gone up by 50% or whatever the case may be. It must be because I'm a great investor, or it must be because I've bought a house in a great location. It doesn't give a shit, right? It's your money's just bought less goods. The money's been devalued, and the reason why it's become devalued is because it's been cheaper to print and cheaper to obtain, and there's no way to turn the system around because we've gone way too far and way beyond the point of no return. So house prices in Sydney might have gone up, and house prices in Melbourne might have gone up, and house prices in Brisbane might have gone up, and every state in the country is saying the same thing. And then you look at that and go, it must just be Australia's a great place to live. No, because when you go to Canada or the UK, the UK was in lockdown for a whole year. The economy was completely screwed. It was shafted. It was fucking burned to smithereens. And then they had the largest property boom in the UK. Why did that happen? It happened because the cost of money is so cheap. And when you have money or currency, dollars that we use, which cost almost nothing to have, who cares about ever paying them off? So we're on a big party, and the debt party continues on. Looking at, what will happen and what other nations have done, there's a Danish bank which in Sweden has got a negative interest rate of 0.5%, and they're rolling out negative rates in other countries at the moment. This is something that was trialled in Sweden and has been effective, and it's being transitioned to other countries, which meaning if you had $1 million worth of loan and you got a 0.5% negative interest rate, people say, well, it can't happen because the banks won't make their money. No, if the central bank, let's say that the RBA was to make the interest rate negative 3%, and your bank, let's call it Combank or whatever bank you use, let's say one of the big fours, just hypothetically, gave you a negative 1%. It doesn't mean that Combank's losing 1% by giving you the money. It means they're gaining 2%, because the difference between negative 1% and negative 3% is still 2%. So they're making their spread on that front. So it is a real process. It could happen. So you've got to question yourself as to if you were an investor investing in the bonds or investing your money in to lose money, basically not getting as much capital back as what you put in. You put $100,000 and you get $98,000 back, right? People will stop lending at that point, and will have more and more issues. So it's a very interesting world that we're heading into. It's the collapse of our currency. We will eventually end up in a hyperinflation, and I've got no doubts in my mind at all with that occurring. But there's certain ways of how to protect yourself. We're heading into a digital currency. Go to the bank and try and ask for money. You're seeing banks close down on every single corner. You go to most places and there's no banks. If there is a bank that's still standing, you go and ask them for money and they won't give you more than 2,000 or 5,000. They generally try and direct you to the ATM and show you how to use the ATM and go, you can pull some money out. You tell them you want to pull 10 grand out. They look at you like you're some weirdo and you're a criminal, probably because they don't know how you could even afford to have 10,000 in your bank account, because everyone's just covered in debt. And, we're losing our banks. We're losing our currency. We're heading into a digital debt-based fiat Ponzi system, which we're already in, but it's just amplifying, especially as we head to a digital dollar. When the transition is finished, we're going to be in a complete digital dollar where there's no exits to that. So looking at, the exciting part about how this can happen, if you had $1 million worth of debt and you're paying, say, 5% interest on that, you'd be paying $50,000 a year to hold that property. But if the interest rate went down to 1% or 2%, which we're almost there now, at a retail level, then it's costing you 10 or 20 grand a year. So you're saving yourself 20, 30 grand a year. So some people have got extra cash flow in their households. So they can pay for highly inflated, loaves of bread and shoes and slippers and shirts and TVs and washers and dryers and fridges and whatever they needed around their house. But looking at, what was I going to say next? Yeah, so if interest rates were to rise, someone's stuck at this level where they've got cheap, easy, accessible and readily available credit, that would take away cash flow from the average household, meaning that they'd have to spend more money to keep their house, keep their mortgage, keep whatever. That's where the squeeze will happen. You wouldn't have people go out on the street spending money. So if people, let's say that a household had 100 grand income and they've got 50 grand going out in mortgage, they've got 50 grand left over to afford stuff. If the interest rates come down to 20 grand a year or 2% on $1 million mortgage, that family would now have $80,000 to spend. But then if the cost of the interest went up to 5% again, that means it would go to 50 grand, meaning that there wouldn't be enough money to spend for Uber Eats and all the other joys of life that we get to have. Then if interest rates would go up further, it would mean that there would be no money to live on. People would be on the food line, which is sort of, people are stretched from either end. Both sides of this is squeezing up. Price of goods is going up. Inflation's going rampant. The cost of money is becoming cheaper. Something has to give at some point along the way. My belief is that we'll have a crack up inflation. We'll go to negative interest rates. And if you have $1 million loan and it costs you negative 0.5%, that means you'll be getting paid $5 grand a year to hold that mortgage. So who really controls how all of this works? It's a system. It's the central banks. It's the controlling powers to be, which are controlling what's happening with the rest of the economy. And they've got more levers at play, like the housing economy is a part of their economy, but you've got the greater economy, which is more important. So, yeah, really, really exciting time that we're living in is that we could be heading into negative interest rates as early as next year. Like, I thought we would have been in negative interest rates by now. I actually predicted that would be negative interest rates in the start of 2020 before Corona ever existed, just given the trajectory of where the bond markets were going and what was happening out there. However, one thing that I didn't see was the extent of stimulus packages that they would be giving us. We've got now a universal basic income, which is pretty obvious out there, be it as a part of the grants, the stimulus packages, JobKeeper, JobMaker, Job Booster, all these sort of stimulus packages which are going out there to help prop up the economy. That takes a bit of pressure off the interest rates physically having to come down into the negative levels. So we can delay the inevitable further and further, kick it down the road. But to think that interest rates are going to be going up, by 1% would be absurd. Seeing them go up by 2% is impossible. Seeing them go up by 5%, you're kidding yourself. It's never going to happen. If that happened, the whole world as you know it would end, which, it basically did over the last 2 years because the whole economy has been, squeezed and pressured, into, different directions. So looking at, the problem, which is the fight against deflation, the reason why we need to keep propping up the economy is that, a lack of spending, would have further job losses, would have lower profits and prices will drop. And it would be an incentive for people to continue hoarding money. If you have a negative interest rate, you won't want to hoard money, so you'd be wanting to spend it, and inflation, which is where it's at, they've got us exactly where they want us to be because people won't save their money anymore. They'll go out there, they'll take out a loan. When they take out a loan, they'll expand the economy, and more money will circulate through and trickle down into the system. If you have deflation that is on the other side of the coin, you've got inflation, which is one side, you've got deflation, and you've got a hyperinflation, and you've got a deflationary depression on the other side. If we had a deflationary spiral, everything would, the whole system would turn to paste. So they need to prop this system up. And how they can, make money cheaper. They can encourage people to spend. They can disencourage people to save and to hoard, and play the currency that we've got a little bit further on down the road. Looking at a bit of a case study here, the ECB in June 2014 lowered the deposit rates to negative 1%. Looking at negative interest rates, the cash that was deposited in the banks charge you to store the money in the bank. So if we had negative interest rates here in Australia, this is a real case study of the ECB, European Central Bank in 2014, when the interest rate went negative 0.1%. If you had $100,000 in the bank, it would cost you $100 a year to keep that money in the bank account. You would pay a storage fee to have your money in the bank. So the worst part isn't that you have to pay to keep your money in the bank. If you got paid 1% to keep your money in the bank, you'd be earning, $1,000 a year. But the problem now is if you put $100,000 in the bank, you pull it out in a year's time, inflation's gone up so great, your $101,000 that you've got, you'd have to pay tax on that $1,000, of course, so give some money back to the system. But the $101,000 that you'd have, you would buy less goods and products and services than what you did 12 months prior. So that's where the real threat comes as we lower the interest rate so low. It's a real fine line that we've got to play here. So looking at the pain of the Europe's negative interest rates, 5 cuts below zero starting in 2014 brought the borrowing costs down, but also squeezed the bank's margins. Long-term cost of borrowings went down, deposit rate paid by banks to non-financial companies and households, ECB deposit rate charged on bank reserve. Basically, the first interest rate cut below zero was in June 2014, and the last cut before the scandemic in 2019 was still well below zero there. So there was 5 rate cuts that went below zero in Europe in the ECB. And I find it very amazing that the last cut that they mentioned here was in September 2019, because that takes us back to exactly what happened. I remember doing a Facebook Live on this before Corona, before anything like that had gone wrong. I did a Facebook Live talking about the repurchasing agreements that are out there in the central banks around the world. And basically, there was a massive bailout because the banking system had started to fail and collapse. And each day, the central banks had to print short-term funding because the yield curve had inverted and gone negative. So basically, looking at the bond rates out there, the bond rate is determined via it sort of determines what's happening with the cash rates around each country. If you have an inverted yield curve, that means that a 3-month bond would pay more than a 10-year bond. But if you're locking your money away for 10 years, you'd want to get a better rate than having it in for 3 months. So when we have an inversion of a yield curve, meaning the short term pays for a higher rate, that's when problem hits. Back in September 2019, the central banks, basically some of the banks in the back end have failed. The central banks around the world, it was never in the news, it was never reported upon, but I pulled the data and the stats from exactly what had happened and started sharing that. What had happened is the central banks were printing money and lending it for the short-term rate to try and flatten the yield curve and to make it just being a positive yield curve, not a negative yield curve, meaning the longer term rates were higher. And it's funny that at the time that all of this went down was quite on the eve of Corona coming out and hurting people. So, with negative interest rates, there will be winners, there will be losers out of this, as we have seen over the last, without negative interest rates, you can start to see what's happening and start to see the trend. The winners out of this will be people that hold debt and people that have debt, because the debt becomes cheaper and cheaper to hold. The losers will be the people that own cash. So if you have $100,000 in cash, or if you have $100,000 in debt, the person with $100,000 worth of cash now has to pay the bank to have the money in the bank, and the person with $100,000 in debt gets paid from the bank to have the debt in existence. Where it really gets messed up, and this is, everyone says save your money, be a good person, put in the bank, whatever. But once again, that's a system telling you what to do. The people that work hard, do a good job, save their money is buying less and less constantly because inflation is eroding the value of it. With all this cheap money being printed, it's just regurgitating out there in the system, and the cost of goods are going up. Doesn't matter if it's a piece of timber, doesn't matter if it's a bit of fencing, doesn't matter if it's a piece of plastic, doesn't matter if it's an iPhone, a computer, a desk, a chair. Doesn't matter, whatever it is, a car, doesn't matter, clothing, everything is rising in value. So if you had $100,000 last year, you can buy less this year with $100,000. But if you had $100,000 worth of debt, it becomes easier to pay it off because everything's inflated. You could just sell off whatever it is that you own and use the profit to pay out the debt. So we're at a point where the monetary system is expanding with these low interest rates. The currency system is expanding, meaning that we're going to have higher levels of inflation, meaning that anyone that's got debt will be a winner. Anyone with cash savings will be a loser. And the most powerful people will be the ones that are holding debt, massive amounts of it, and those of them that are holding debt with massive amounts of assets. It doesn't matter whether it's real estate. Like, real estate is my favorite go-to, but I invest into all different other assets, whether it be setting up a business, and I've got thousands of beds in my motels. The beds in the motels are an asset. The kitchen sinks in all my houses are an asset. The cost of all the timber in the walls, the cost of all the electrical cable in the walls of my properties, all of that is assets to the bottom line. So the more assets that you own, doesn't matter, like a lot of people look at it just as a physical, assets are real estate, assets are, whatever. Assets can be defined in many, many different ways. We're looking in the tech world now, assets can be data, right? Data worth of community. Data is your ID. And that's where I think a lot of people are missing out in Corona, because they're not looking at, the opportunities that are out there. The opportunities are endless. This is the most exciting time to be alive, and many, many different ways to capitalize on that. People ask me, Nathan, so probably like the top 5 questions I have that people ask me is, will interest rates go up? Interest rates can go up, but they're limited as how far they can go up. What's the chance of interest rate going up? Very, very slim. And if it does go up, I can't see going up more than 0.25%, maybe 2 times 0.25%, so 0.5% worth of interest rate rises. People ask me, Nathan, what will happen when the whole system implodes? Will our debt will the banks just not want our money or whatever? You'll be able to pay off your debt with worthless currency. So an inflated or a devalued currency, if everybody's on 50 grand a year today and the income goes up to $5 million a year and a Big Mac meal's $100,000, you can pay off your debt of 200 grand very, very easily compared to what you could have paid off your debt previously to the hyperinflation. So that's another aspect of it. Savings, should I save money? I'm not a fan of having currency in the bank. As soon as I get currency, I get rid of it. Basically, this is something that's funny. Like, a lot of people, no one knows this really. Every day, I look at my bank accounts before I go to bed, and I get rid of every cent that's in there, whether I buy something, whether I pay some bills, whatever happens. I like having no money in my bank by the time I go to bed. When I wake up, money comes through because I focus on cash flow. I don't want cash sitting in the bank. The cash is stagnant and it's losing its purchasing power and losing its ability. So I get rid of that cash as much as I can. And my favorite thing is to go and buy cash flowing assets. I want to buy assets that are going to be putting money back in my bank account. So I wake up the next day and there's more and more money going through. And I think everybody, as people, like, we spend money on a daily basis. We should be getting paid money on a daily basis. So, that's one thing to look at on that front. And another question that I get asked from a lot of people is, is now time to be paying off on my mortgage? Like, shouldn't I be paying down my mortgage? And I always sort of think about this and answer it very carefully, because a lot of people may misconstrue this as financial advice, and obviously nothing I say is that way inclined. But looking at paying off a mortgage, if you were to earn $1 million today, let's assume $1 million hit your bank account and you've got $1 million mortgage. Most people would, first thing, take the $1 million, pay out their mortgage and go, now I've got my property owned outright. Great. Cool. But how are you going to make more, money tomorrow, right? Like, you have to get up out of bed to pay for your food, to pay for your living, to pay for clothing, to pay for electricity, water, cars, utilities, whatever the case may be. For me personally, if I had $1 million mortgage and I had $1 million hit my bank account, I'd first acknowledge that as that money hits your bank account, you've got to pay tax. Most people are paying 30, 40% in taxes. So if you had $1 million hit your bank account, you'd really only have, 600 grand that you could use, which if you were to pay that off, your mortgage, you're getting $1 million, you're paying 30% in tax just to save yourself 2 or 3% interest rate, which could be down as low as 1% or even -% in the future. So, if you were to earn $1 million and pay out a mortgage, you're just saying that you can't get a better return than 2 or 3%, and you've totally ignored the fact of inflation, because you've got the cash flow component, which is the money in, money out, but then you've also got your asset, which is being inflated away. So you need to look at the asset value rising plus your cash flow position. So if it was me and someone gave me $1 million and I had $1 million mortgage, I would rather go and spend that $1 million on buying another $1 million worth of asset. The reason being is if I had $1 million worth of asset that was bringing me, say, a 7% return, that would be $70,000 entering my bank account. With that $70,000, I could then use that cash flow to pay out the debt attached to the other loan and have a profit of the cash flow in my bank account. Secondary to that is that I would have two assets. Let's assume that your $1 million mortgage was a $1 million house, so you had no equity, just for hypothetical. You would only have, if you paid out that mortgage, you'd still only have that $1 million asset. If that doubled, that would turn from $1 million to $2 million. But if you had that second million and you bought another $1 million worth of asset, you would have two assets that are being inflated away in a very high inflation environment. So you'd have two hooks in the ocean, you'd have two lots of growth, you'd have double the amount of growth, you'd have more cash flow coming through. And we haven't even talked about the fact what would happen to the cash flow if we had a high level of inflation. Could that cash flow go up from 7% to 10% to 15 to 20% as things go crazy? So is this a time where Nathan's paying out his mortgages? Absolutely not. Will the day come, and this is probably my last question, will the day come where you will pay out debt? And the best way that I could answer that is yes, there is a debt consolidation strategy in my portfolio, but today is not that day. The day that I do pay down my debt is the day that I see the system completely imploding, and I see high levels of inflation, and there is a potential risk that interest rates could go up. And if you look at all nations that do have a currency collapse, as the currency collapses, they have a hyperinflation. And then the other side of the hyperinflation, that's when interest rates go up, and they go up crazy levels. They might go up, double. They might go up to like 10%, 20%. I think it was in Turkey that they went up like 60% interest rate going back about 4 years ago. So looking at interest rates, can they ever go back up? Yes, but when they go up is after the currency has been well and truly eroded and collapsed. So yeah, looking at the potential there of how you can benefit via negative interest rates. Having debt, you can benefit. Having money in the bank account, you will be, impacted negatively on that front. So just be careful with what you're putting your money into, how you're spending your money. Spend it wisely. Have an understanding of how money works. Have an understanding of how the system is working, and understand what could come next. Is it, obviously B.Invested, we're here to help people build property portfolios. I have a buyer's agency where I buy properties on behalf of other people, etc. It's not all about just buying properties. It's about having other assets and other tools in your portfolio. So looking at, your position, should you be buying property? Should you be, buying cash flow producing assets? Should you be buying, looking at your portfolio, should you be buying cash flow producing assets? Should you be paying down debt? Should you be buying property? Should you be buying Bitcoin? Should you be buying, precious metals? Should you be starting a business? There's lots and lots of questions to put in the equation. Sometimes it's a bit hard to work out where to navigate and where to turn to. Here at B.Invested, I've got a whole team of experts that specialise in giving different levels of advice. Sometimes that involves financial planning and financial strategy. Can help you on that front. Can put you in contact with one of our financial planners if you need. If you want to start off with, having a bit of a discovery of where your position is at the moment, my team are very experienced with helping people and shepherding into the right direction. So if you do require some help on setting up a strategy, feel free to reach out to the team. You can call us at 1300 367 925, email us at admin@beinvested.com.au, and my team can have a discovery session with you and work out, where you're at, what you're trying to do, and then put you in contact with the right experts to be able to, help you navigate, not just to survive, but to prosper and benefit from the opportunities that are out there, because 2021 is just the start of how much exciting things are happening out there in the world. As this currency dies, there'll be a lot of people that thought they were safe, will be unprotected. A lot of people that didn't realise the potential that understand how things happen will be able to clean up and take real advantage of the years to be ahead. So yeah, if you need help, feel free to reach out to the team. And as always, you can listen to us on Apple, Spotify, Google, and check us out on YouTube at youtube.com/B.Invested. Thanks a lot for tuning in. We'll catch up soon. Have a great day. Bye for now.
Like Bilal said, man, we're stuck in the matrix. This my advice, don't care if you take it. The dollar about to die, soon to be hyperinflated. This my 2 cents, don't care if you save it. Joint be decentralized and you will see you been lied to the whole time, and it's the irony, cause they do the exact opposite. You become a slave to the system, enough your money, all they do is profit. There's no conspiracy theory, you better hear me. Crypto will set you free before the system does. I don't care if you do or you don't, but what I'm saying is the truth to the reason you choke. I've never been a failure, excuse my behavior. Keep talking, haters doing me a favor. They all tell lies, I know what they been telling you. I'm the opposite of Donald Trump of Australia. It's amazing, here for the taking, my time is never wasted.